Writing call and put options allows the option writer to collect premiums and make money like an insurance company. Further, writing call options on equities owned by a call writer provides the call writer a certain amount of hedge, whereas the worst case scenario for a put writer who writes an out-of-the-money put option on an equity that the put writer wouldn't mind accumulating allows the put writer to purchase the equity at a discount. What's going on, everyone? Today I'm going to talk about option strategies revolving writing calls and puts. I'm going to start by showing two examples of a call and a put option that I wrote today. So let me show an example of selling a call of AMD. I currently own 300 shares of AMD, so this will be a cover call, and the strike price I'm going to pick 10% above the current price, so around $117, and the expiration I'm going to pick around 45 days, so around September 17th. So I'll pick a 120 call, and I'm going to sell to open, one contract, strike price 120, call order, we'll just do limit somewhere in the middle, 203, and the premium is going to be $2.03 per share in a contract of 100 shares, so I should receive $203 of premium, and the order has been placed. The premium is $203. I gain $202.35. If AMD closes at or above 120 on September 17th, then 100 shares of my AMD gets called away. If it doesn't close at or above 120, then nothing happened, but regardless, I keep $202.35 of premium. Now let me show an example of selling a put. Same principle as earlier. Amazon is currently trading at $3,330. I want to sell a put that's about 10% cheaper than the current price with an expiration date about 45 days away. So I'm picking $3,000 strike price and September 17 expiration. I'll enter in one contract. Limit, we'll pick 2665, and as shown here, I receive a premium of $2,664 in return for being obligated to buy 100 shares of Amazon should Amazon fall to 3,000 or below on September 17th. My break even for this trade would be actually even lower than that since I'm receiving a premium. The maximum loss I have would be around $290-some thousand if Amazon goes to zero, but the likelihood of that happening within the next 47 days is very low. And also, in case it does drop below, I can always roll this option down and out. Here are some strategies when writing put options. First, pick an equity you would like to accumulate. In my case, I picked Amazon because Amazon, in my opinion, will dominate the world, and I would be happy to own Amazon long term. Second, pick a no-brainer strike price you're willing to buy the equity at. For me, Amazon was trading at $3,300 at the time I sold my put and was down 7.5% for the day, despite posting amazing earnings. Normally, I would consider buying Amazon the stock at $3,300. However, since I'm writing puts, I chose a no-brainer price of $3,000, which is at another 10% discount from the current trading price. At the price of $3,000, it is a no-brainer for me to pick up Amazon. So why not get paid a premium to have an opportunity to buy Amazon at $3,000? Third, and this is probably the most important point, do not over leverage. And by that, what I mean is do not sell naked puts. I sold Amazon on account with over $500,000. The maximum loss of this put if Amazon goes to zero is $297,000. I don't think Amazon's going to go to zero, but in the worst case scenario, I would have to sell around $300,000 worth of shares to come up with the money. However, if I were to sell 10 puts, I would pocket over $26,000 of premium. However, if Amazon goes to zero, then as you can imagine, there's no way I would be able to pay for 1,000 shares of Amazon should I get assigned. So please do not over leverage. For a beginner who is just getting his or her feet wet, I recommend selling only cover short puts. What this means is if you sell a put of Amazon and the maximum loss is $300,000, then your account should have that $300,000 in cash, just in case you get assigned. Delta is sometimes used as a rough estimate on the likelihood of assignment. And here the negative sign just means that I rolled to open the put. The decimal should be interpreted as a percentage. So 0.1435 means that at this current time, there's approximately a 14.35% chance that Amazon would close at or below $3,000 and I would be assigned. So So as you can see, the likelihood is fairly low, but as I said earlier, there is always a likelihood. However, keep in mind that the likelihood is only based on the current set of circumstances, not based on future events. So as I stressed out earlier, please do not over leverage. Finally, as a put writer, time decay or theta is your friend. So let time decay work for you. The premium of every single option has a time component. And for out of the money calls and puts that we're writing, the time component constitutes 100% of the premium. So theta of negative 0.7726 means that there's a time decay of 77 cents per share or $77 per day, provided that nothing else changes. And that time decay is always going to be negative, and it's going to gradually increase over time. So let that be your friend, and let that time decay eat into the option until the option expires worthless. And finally, consider writing 1 year out or longer puts for tax benefits. After 1 year, any gains would be treated as long-term capital gains and therefore could significantly reduce the amount of taxes you would have to pay. And here's a spreadsheet of current put positions that I wrote. The green highlights represents 1 year out put options that I wrote back in March and May this year. As you can see, the March 18, 2022 expiration QQQ puts with 310 strike price has already depreciated 64%. And my gain for this position is $9,100. Similarly, the QQQ June 17, 2022 expiration put with a strike price of 320 that I wrote in May has already depreciated 50%. So QQQ would need to drop 13 to 15% before either put option is in the money. So in my opinion, both put options will expire worthless, and I would collect $30,000 of premium between the two options. And moving on to call options. First of all, if you're watching this video, you do not want to be writing naked calls. In fact, unless you have a significant amount of experience, I strongly recommend only writing cover calls. What cover calls means is you already own the underlying asset. So AMD, for example, I own 300 shares of AMD. I can write up to 3 cover calls of AMD. So you want to pick a no-brainer price for an equity that you're willing to part with. AMD was trading around $103 a share at the time I wrote my cover call. I selected a strike price of $120, and that's over 15% above the current price with an expiration date of 45 days. I've made multiple videos saying that I think AMD is going to hit 120 by November. However, keep in mind that AMD has been on a tear for the last 3 days since reporting amazing earnings. I asked myself, how much can AMD go up within the next 45 days. When I wrote my cover call, I don't think AMD is gonna explode past 120, but if it does explode past 120, I'm willing to sell some of my shares of AMD at $120 a share. Similar to writing put options, you want to use delta as an initial estimate on the likelihood of assignment. So currently, the delta for this AMD call is 0.23. So it means that there's a 23% chance of likelihood of assignment. And finally, just like writing puts, let time decay work as your friend. For my AMD cover call option, the theta is negative 0.0488. What this means is there is a 4.8 cent per share decay on the option per day. And since a call option corresponds to 100 shares, then there's about a $4.90 decay for the call option. As I mentioned earlier, this theta is going to increase over time. So let the theta decay eat away the call option until the call option expires worthless. Further, you can combine call and put options to wield a equity. What this means is you would sell out of the money put options on an equity that you wish to own until it's assigned. So for example, I would sell puts on Apple until I get assigned. And then once I'm assigned, I would sell out of the money cover calls on Apple until the cover call is assigned. And then I would rinse and repeat to collect premiums, dividends, and appreciation of the underlying equity. And here's an example of me willing Apple. I started selling out of the money puts on Apple in March this year. Until in June, I was assigned Apple May 28th expiration puts at $127 a share. Once I was assigned the puts, I started selling cover calls of June 30 expiration Apple with a strike price of $137. My cover call was eventually assigned and the 100 shares was called away at $137. And as you can see down here, this is a breakdown of all my gains. My gains from owning the equity from the time I was assigned the cover short put to this time that my cover call was called away was a little bit less than $1,000. My gain from selling puts was $843. My gains from selling calls is $118, and my gains from collecting dividends is $6.65. The total gain from wheeling Apple over the last 4.5 months is a little bit less than $2,000. Let me know in the comments below if you have any questions regarding writing call and put options, and feel free to check out my videos on trading a $500,000 portfolio to $5 million, in which I talk about writing call and put option. As always, thank you so much for watching, and please hit the like and subscribe button.